Welcome to the deep dive. Okay, so today we're taking a bit of a detour. We're moving away from software and consumer stuff
Yeah, different world entirely.
and diving into, well, the really nitty-gritty, super efficient world of industrial manufacturing. We're looking at Gevorkyan.
Right. A name most people probably haven't heard, maybe, but their components, they're absolutely everywhere.
Essential B2B is a good way to put it.
Definitely. They do high precision metal parts. Think powder metallurgy, sintering, metal injection molding, even 3D printing, advanced stuff.
And the everywhere part.
Oh, yeah. Over 3,000 different parts for like oil rigs, cars, sure, but also anti-drone systems. And kind of surprisingly, even parts for fancy cosmetics packaging.
Cosmetics and defense, maybe off the same line. That's something.
That shows the range, definitely.
Okay, so our sources for this deep dive. We've got their H1 2025 interim report. Pretty detailed stuff.
And also that independent analysis from Gafrik Research gives a good outside perspective.
Exactly. So our mission here is, well, twofold. First, figure out how they're getting these impressive financial numbers. And second, really unpack this big strategic shift they're making into defense.
Yeah.
What's the risk? What's the reward?
And you see those numbers right away, they really pop. It's not just, slow and steady growth.
No, it's high margin stuff. First half of 2025, revenue up 11%, hit $42.15 million.
And EBITDA up 15.2%. That's $13.77 million. Solid jumps.
But here's the number that really made me sit up, the EBITDA margin. It clocked in at, wait for it, 32.7%.
Yeah, that's huge in heavy industry. Really stands out.
Way above their peers. So, okay, let's dig in. How are they pulling this off? What's the secret?
Well, it starts with their foundation, right? They've been building this since '96. It's about that deep technical know-how.
Moat around the business.
Exactly. World-class R&D in Slovakia and Austria. And they're not just order takers. They develop like 200 new products every year.
And that huge product range we mentioned, over 3,000 parts, that must help stabilize things.
Absolutely. You've got oil and gas, auto, defense. That's about 15% of revenue.
But then completely different sectors, too. Medicine, cosmetics, fashion. That's another 17%.
Right. So if one sector dips, other can pick up the slack, smooths things out. And geographically, they're spread out, too. EU is 58%, North America 23%. Good balance.
Okay, diversification helps, for sure. But that 32.7% margin, I mean, the peer average is, what, 21.2%?
Yeah.
The real secret have to be in how they operate.
It is. It comes back to the core technology. That's the engine.
Things like MIM and sintering.
Exactly. Those processes, they fundamentally change how you make complex metal parts.
Right. For someone listening who isn't familiar, what's the big advantage over, say, just machining metal down, cutting it away?
Okay. It's about complexity, precision, and crucially, less waste. Traditional machining cuts away material, creating scrap. It struggles with really intricate shapes.
Right.
Sintering and MIM, though, they use fine metal powders. You press them into molds, heat them up. You get incredible density, complex shapes like internal channels, tricky undercuts with almost no waste.
Fewer steps, less material cost per part.
Precisely. And that's how you get super efficient.
Okay, so that technical edge directly fuels the efficiency numbers, which leads us to labor productivity.
Bingo. This is the key metric from the report. Revenue per employee, $224,000.
Wow. And the peer average?
$164,000. That's a $60,000 difference per person. That's where you see the automation, the optimized processes paying off.
They're getting, what, like 37% more output per employee than the competition?
Pretty much. And that is how you get to a 32.7% EBITDA margin. It fundamentally comes down to that productivity.
And that efficiency, naturally, drops straight to the bottom line. Net profit earnings after tax, ET grew almost 18% year over year.
Yeah, $2.95 million. It just confirms the whole operational machine is running really, really well.
Okay, but they're not just sitting back and counting the cash from that amazing margin, are they?
No, not at all. That operational strength is actually funding the next big chapter. They are spending aggressively.
Which brings us to segment 2, this heavy investment cycle, CapEx.
Right. Pouring money into robotics, more automation, expanding capacity, even ESG stuff, partly using green bonds. It's a major investment push.
And spending that much cash has consequences, at least in the short term. Creates a bit of tension in the financials.
It does. Growth needs funding. So their net debt to EBITDA ratio is up around 3.2x now.
Okay, 3.2x. For a manufacturer, maybe a bit cyclical. Is that pushing it, even with those margins.
Well, it definitely shows they're serious about growth. It's generally seen as acceptable for a company in this kind of expansion phase. They have the EBITDA to cover it. But yeah, you're right. It's a deliberate choice to take on more financial risk for a future scale.
And you see that trade-off reflected very clearly in their return on capital figures.
Yeah, the return on invested capital, ROIC, took a sharp dip temporarily, down to 2.46%.
And it was over 7% just in Q1. That's quite a drop.
It is. And this raises a really important point, maybe why the market seems a bit hesitant. That 2.46% per ROIC, it's temporarily below their estimated WACC, their weighted average cost of capital.
Okay, so WACC is basically the cost of their funding, debt, and equity combined, the minimum return they should be making.
Exactly. It's the hurdle rate.
So if ROIC is below WACC, they're spending faster than they're currently earning back on those investments.
Precisely. But this isn't, a sign the business is failing. It's the financial signature of a company going all in on investment now for much bigger returns later.
They're betting the farm on these CapEx projects, paying off big time.
Yeah, they expect things to normalize, get back above WACC, starting, they say, from FY 2026.
So it's about prioritizing long-term dominance over maximizing short-term returns right now. Makes sense. And the cash balance dropping confirms this spending spree.
Absolutely. Cash and equivalents fell by about a third, 33.35%.
Yeah.
Perfectly normal when you're in this kind of build-out phase. Free cash flow is probably flat to slightly negative. They're building, not harvesting. Not yet.
Okay, so let's pivot. All this investment we just talked about in segment 2, it's not random spending. It's highly focused. Which brings us to segment 3, this massive strategic shift into defense and aerospace.
Right. This is where the money and the effort are going. New contracts, the whole geopolitical situation, it's driving this.
They're seeing a big opportunity.
Huge. In just the first half of this year, they finished development work on some critical, likely high-margin defense parts.
Like what?
Components for night vision, thermal imaging, laser systems,
Yeah.
anti-drone tech, really advanced stuff. They're even working on parts for specialized rescue vests for the Navy and Air Force.
Wow. Okay, but shifting from, say, cosmetic parts to defense components. That's a huge leap. The barriers must be enormous. Certifications, right?
Oh, absolutely crucial. These aren't optional. They're the keys to the kingdom for high-value government and aerospace contracts. They're implementing AS9100.
That's the aerospace quality standard.
Correct. And AQAP 2110, that's the NATO defense standard. Gold standards, both of them.
And it's not just about making the parts right. It's about security, too. Data security.
Definitely. They're also going for ISO 27701, that's Information Security Management, and TISAX.
TISAX. That sounds familiar. Automotive?
It started there, yeah, protecting sensitive design data. But that same level of rigor is now essential for defense work, too. Getting all these certs is basically the ticket to get listed in the OASIS database.
The online aerospace supplier information system.
Right. That's where the big prime contractors find their suppliers. You need to be in there.
And showing just how serious they are about this.
Yeah.
They're actually splitting the business.
Yeah, this is a major structural move. By the end of 2025, they plan to set up a completely separate, wholly owned company, Gevorkyan Defense.
Smart. Why do that?
Well, it lets them really focus the R&D and the production for these specialized defense parts, like innovative ammunition components, rotational rings, composite cartridges, that kind of thing.
Streamlines everything. Compliance maybe attracts different investors.
Exactly. It simplifies compliance, makes it easier to attract defense-focused capital, and it sends a really clear signal to the market. We are a serious, dedicated defense supplier.
And to build out the actual manufacturing footprint for this global specialization, they're buying companies. M&A.
Yep. A clear strategy there. They bought facilities in Sweden in 23, Poland last year, 24, and now they've got one pending in Italy for this year.
So it's not just buying random capacity.
No, it looks strategic. Optimizing the whole production network. They can decide what gets made, where core stuff maybe stays in Slovakia, specialized Italian sites handle other things. Smart portfolio management.
And making sure they have the cash for future deals, too.
Right. The board got approval back in June 25 for a potential capital increase over the next 5 years. It just gives them flexibility. If the right acquisition target comes along that fits the defense strategy, they'll have the means to act.
They're really positioning themselves as a core part of the European defense supply chain, aren't they? Not just another supplier.
That seems to be the goal. Critical infrastructure, almost.
Okay, let's wrap up with segment 4. The outlook, which, based on everything we've heard, sounds incredibly positive. But there's this weird disconnect with the market.
Yeah, the company's own forecast is very bullish. Management's clearly confident.
For 2025.
They're guiding for 11% to 18% revenue growth and EBITDA growth between 15% and 23%.
And they're actually aiming to push that already amazing EBITDA margin higher.
Apparently so, targeting 36%, which is quite something.
And longer term, say the next 5 years.
Solid growth projected there, too. CRGR through 2029, 16% on revenue, 18% on EBITDA. These numbers suggest they really believe they've unlocked something big.
Okay, so the company's confident, the strategy seems clear, but the market isn't buying it yet. This is the disconnect.
Exactly, and this ties right back to that short-term pain we discussed in segment 2, the heavy investment.
The Gafrik Research analysis pointed this out, right? Stock price is actually down.
Yeah, down over 20% since the start of the year, despite the strong performance. So why?
Why ignore great margins and growth?
Well, the analysts suggest a couple of things. One is maybe low stock liquidity, which can always drag on price. But the bigger issue seems to be the market is fixated on those short-term metrics.
That temporary dip in ROIC, the higher leverage.
Exactly. The market sees the debt, sees the return on capital temporarily below the cost of capital, and maybe gets spooked.
And it's overlooking the fundamental strengths. The 32.7% margin, that fantastic labor productivity, the strong order book.
That seems to be the story. Analysts put the fair value somewhere between CZK 310 and 330. The price on June 30th was CZK 216. Big gap.
So the current price just isn't reflecting the underlying value or the growth strategy.
The argument is that the market hasn't quite grasped that the lower ROIC is a feature of the growth plan right now, not a bug. It's the cost of building for the future.
Okay, so summing this up for you, the listener, Gevorkyan is a fascinating example. A highly specialized industrial company using advanced tech like sintering and minim
to achieve really exceptional efficiency. That 32.7% EBITDA margin, the high revenue per employee, that's proof it works.
But it's a story with two sides right now. You've got this incredible current operational performance
running alongside a massive, arguably high-risk but potentially high-reward strategic pivot into defense. New company, Gevorkyan Defense, M&A in Italy, all funded by that heavy capex that's pressuring the immediate return metrics.
Which leaves us with a final thought for you to consider. Gevorkyan is deliberately accepting lower short-term returns on its investments, ROIC below WACC, to fund this huge expansion, particularly in defense. So the big question is, how quickly does that new Gevorkyan defense unit and those Italian operations need to start generating significant cash flow to really validate this strategy? How soon does the payoff need to arrive to justify the current financial pressure?
Yeah, it's that classic tension, isn't it? Short-term financial prudence versus long-term strategic ambition. Where do you strike the balance?